idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
On the air, online, on podcast, we are here once again helping people discover, protect, and share true financial independence. It starts here at the offices of GenWealth Financial Advisors and on the Get Ready for the Future show. We thank you for joining us. As always, wherever you get the show, we are glad to have you along. My name is Scott Inman, and GenWealth co-founder John Shrewsbury is in the other chair today as we get set to answer your questions as we do each and every week on the show. And John, we've got some good ones this week. We're going to be talking about investing, and we're going to get into the weeds a little bit more than we even normally do on the show, just based on the current environment and current events that have taken place earlier this week. We've also got some questions about how's the best way to pass money on to the next generation, and we even have one about from someone actually considering a job change. So we're covering all the bases today.
Lots of bases. We're ready to rock and ready to roll.
So our first question, let's jump in. Joey via email writes, how should I approach the financial sector in light of recent banking sector volatility and the rise of fintech companies? Joey, thanks for your email. So as we dive into the investment conversation, you think about Joey's question, and he's thinking about how to approach the financial sector. The financial sector is overall still strong, and in fact, with interest rates where they are, they have been cut late in 2024, but now we're talking about potentially holding serve a little bit on interest rates. And if they do go down any further in 2025, it would, take an external event that we're not really probably foreseeing at this point, which could happen, or it would be a more gradual decrease than I think many people thought at one point. So keeping interest rates elevated, John, I think overall that's the first thing I think of when you think about how should you view the financial sector.
Yeah, and Scott, I believe after what are we now, a couple of weeks into the Trump administration, I just believe you just don't know what's going to happen because it's really hard to it is a completely different world in terms of how fast the administration is moving on lots of different things and some of the dramatic things that they're trying to change. And of course, there's a lot of pushback on this and everything, but the political scene has never been more fluid, let's call it that. And, when President Trump talks about, well, I know more about interest rates than the Fed does, and I want interest rates to come down. Who knows how that has an effect on the bond market and all of that. There's just a lot of uncertainty about this. Now, the financial sector, I think, is very strong, and I think that there is a lot of pivots that the financial sector can do based on whatever comes out of Washington and politics and all of that. But I do want to point out, Scott, that investing in any one sector of the market is a little like trying to time the market and trading stocks. And it's really not something that we totally focus on. Is the financial sector a very viable part of an asset allocation portfolio? Absolutely so, without a doubt. And trying to time that is really, you're just going to get yourself in trouble. I think that financial companies are really in good stead. But I think that you've got a lot of things going on in the economy that can wrought some change to the financial sector.
Mm-hmm.
I think that when you take a look at the rise of fintech companies, and the fintech is short for financial technology, it just in our industry alone, technology is revolutionizing our day-to-day operation. What does that mean for us? What does that mean for GenWealth? It means that we can be more efficient. And theoretically, that means that we can be more profitable if we manage that the right way. And so when you think about how that kind of permeates through the financial sector, I think technology gives scale and leverage to the financial sector that we haven't seen in quite some time. Now, I also have a philosophy about technology, Scott, and this is one that, this is just totally my opinion. But I believe that technology is great, but technology can only progress as fast as humans will adopt it. And I think that tends to slow things down a little bit when you get some, I'll go Alan Greenspan for a moment, some irrational exuberance about things sort of like NVIDIA. And, that stock was bid up incredibly so because they're just about in everything fintech and everything technology-wise. But I think we have to sometimes think about this and go, okay, are we getting a little bit over our skis? And I think that happens both in technology as a broad sector and in fintech as it relates to the financial sector.
And I want to get into that, especially as it pertains to AI, because obviously that was in the news earlier this week as well. I want to dive into that a little bit. But just to kind of wrap up on Joey's question, too, when he talks about the rise of fintech, I think he sees that as a potential negative draw on the the banking sector, because there is a concern with the rise of fintech companies that they might replace or supplant financial companies in serving the public. I don't really think I buy into that. I think that back to John's point, the adoption of technologies that help financial sector companies operate in a more efficient manner could lead to more profitability. That's our expectation here at GenWealth. So technology is not necessarily going to be a deterrent to the banking sector. It could be additive to the banking sector. And then one final piece, too, we talked about interest rates, but there's the other piece. When you mention the Trump administration, that also brought to mind the hope or expectation even of deregulation. And I think that's a piece, too, that would make shed some light on the financial sector in a good way, positive performance. But back to a couple of points here for Joey, and to wrap up the question before we go to AI, I think the thing that you have to keep in mind, as John talked about, is asset allocation, diversification. You can't afford, and I don't know that he's saying this in his email that he wants to, but you can't afford to go all in any sector of the economy or the stock market. You always have to have a diversified approach to reach your long-term financial goals. Stock market investing or stock investing should be seen always as a long-term process. Now, on a year-to-year basis, we use the terms, and this is what I think you should get used to, too, if you're listening, is underweight and overweight, right? Sometimes there is a lean, that's the way I describe it. There is a heavier lean towards something like a financial sector allocation or a heavier lean against technology, and that's where the help of a financial advisor can really help you determine on a year-to-year basis what small tweaks might need to be made to your asset allocation mix.
But those tweaks are not going to make or break you.
Right.
And that's how asset allocation is designed. That's what diversification is designed for, is to keep you from going all in and being, either it's win or lose and a zero-sum game, so to speak. Scott, let's talk about this whole AI thing, because that is just on everybody's mind. And, AI is used by a lot of fintech companies and can be leveraged really for, as we've said, greater efficiency and all of that. But in the financial industry, what AI can probably never do, and I'm saying probably never because I'm an old guy and I never would have thought I would have seen AI do what it's doing right now. So, for 20, 30, 40 years down the road, maybe it can do this. But right now, AI does not have the ability to employ empathy, judgment, or reason when working with people and their finances. What it does have the ability to do is to make what I call an A or B choice based on historical data that it researches and says, okay, this choice would be better than this choice. That's easy. AI is perfectly designed to do that type of work, but what it can't do is know you and know your goals and your vision for your life and your desires for your future and how that intersects with your money. The empathy and the judgment of a financial advisor, I think, will survive long after the new has worn off of anything AI.
All right, I want to, before we move on, have a little bit of a sidebar.
Okay.
Because we talked about this before we went on the air. So I want to put this, pose this to you, because I was not in the financial services industry in the late 90s. But if you look at market performance in chart form, historical charts, Certainly, there are some comparisons that are visual to me and certainly being made by the experts that are out there, comparing where we were in the late 90s, which we were on a high and exuberance was high. Matter of fact, that's probably when Greenspan said that, right? Was
that's
roughly
right.
in that time frame, over the internet.
Right.
That was the technology of the day that was just launching and everybody was jumping on board. Compare that for me in your mind, having gone through that in the late 90s to where we are now with the exuberance over artificial intelligence.
I would like to think that we're a bit more smart and mature about this today than we were back when the internet was just kind of emerging. I can vividly remember being at home sick, watching Financial News Network and them talking about, well, you know, we're all going to just be sitting around in our bathrobes and not ever having to work again. Wrong. That's not what the internet did. The internet actually enabled work and actually made more work for people, to tell you the truth. But I do also remember, Scott, that there were companies that made zero money, like no profit at all, and very little revenue, that had .com behind their name, and their stock price went to $200 a share or something like that. So yes, there was a lot of froth in the market back then. I don't see that as much today, but I do see people kind of getting a little bit ahead of themselves in terms of how fast AI can be adopted into the landscape and all of that. Most people think when things are going up, it's just going to be straight up to the moon, and it just doesn't actually work out that way.
Yeah, it always comes back to fundamentals, and with those valuations high, that means earnings are going to have to keep up and maybe catch up in some cases for the stock market on the tech side, in the tech sector, to continue to go. One final word about that. We know that many of you have heard the term deep seek for the first time in the last 7 days or so, based on what happened on Monday of this week in the market, and that's an AI type firm competitor from China. If you want to know a little bit more about what happened earlier in the week and what our thoughts are moving forward, I want to encourage you to sign up if you haven't already to receive the fastest 4 minutes in finance delivered directly to your email inbox every Friday morning. It's a piece that we do that is always topical to the markets, the economy, your money, anything related to retirement could be on that segment. And the reason it is called the fastest 4 is because we do it in 4 minutes or less. Usually it's going to come in around 3.5, generally speaking. If you would like to get that delivered to your email inbox every Friday, and we're not going to blow your email inbox up past that, it's just to subscribe to this one email per day with one email per week with the fastest 4 segment on it. Just text the word FAST to 501-381-5228. Again, the number is 501-381-5228. Text the word FAST, and we'll get you signed up for the fastest 4 minutes in finance. Our next question is from Anthony in Hot Springs. I'm 62 and thinking about making sure my kids and grandkids are taken care of after I'm gone. How can I ensure that my estate plan keeps my wealth intact for them without being eaten up by taxes or other financial burdens? Well, Anthony, thanks for the question. You know, the easiest way to achieve this is to have a full-on estate plan in place and to update that plan when there are significant changes to the tax code. So what do we mean by that? We're going to dive into that. And he does reference his estate plan. So, John, I think there's some general assumption from Anthony's question that he's made one. What that is, how detailed it is the first thing that we would want to look at. Does he just have a will? Does he have a will and a trust? Yeah,
and I think that's the starting point. But let's also talk about the whole taxation thing, because there is an estate tax in this country currently at about $13.5 million. That's the threshold. So if your estate is below that, you are not subject to, or your estate is not subject to estate tax or transfer tax from one to the other. Now, that doesn't mean that your assets will transfer without any taxation, especially if they are qualified assets. Scott, we've talked on this show many, many times about what happened with the Secure Act and IRA assets. That's a big concern if your wealth is concentrated in qualified accounts. And most people's wealth is concentrated in qualified accounts. Most average Americans, the 401ks, the IRAs, 403bs, those are where our dollars rest. And those dollars, when they are passed on to a non-spouse beneficiary, are subject to taxation over a 10-year period of time. Unfortunately, it's one of those things, Scott, that usually the people who are inheriting those dollars, they've had elderly parents. Yep. They're in their prime working years. They're in their prime earning years. And so all of that inheritance money over that 10-year period of time rests right on top of all of the other income that they're making, and it gets taxed at one of the highest tax rates. And so that's the challenge that you have there. And we've seen, some reaction to that, people thinking about using life insurance to create the liquidity to pay those taxes so they get all of that inheritance instead of, 20 or 30 or 40% of it or whatever that works out to. So I think that's kind of where we are. But everything's questionable going into 2025.
Yeah, and that, because that could sunset. So you're talking about the 2017 tax cuts that were enacted in the first Trump administration. If nothing changes, those don't get extended, that's going to sunset at the end of 2025. So we could be seeing a change in the estate tax exclusion, which right now is $13 million for an individual, so $26 million if it's a couple. But if it is brought down from there, which I think if nothing is done, it gets cut in half.
That's right. Yeah. There's some trepidation on the estate tax. Well, let's talk about the what ifs as far as income tax is concerned. There is a bill actually filed in Congress right now that would eliminate the income tax and replace it with a consumption tax or a sales tax, a national sales tax that would have some provisions in it for people that buying, essentials and things of that nature that you wouldn't be taxed on that. I don't know whether that has a chance, and where, of passing or not, but they're talking about it.
Yeah.
And so, I had a client come to me the other day and say, hey, I may want to, do some Roth conversions and all. And I said, let's just pump the brakes and see what happens for just a little while before we actually pull the trigger on that, because the worst case scenario in that, Scott, would be that you do a Roth conversion, pay tax on, I don't know, $100,000 or something like that. And then next year they repeal the income tax. Right. And you go, man, I just paid all that tax for nothing.
Right. And you will have some time, you're going to have if anything passes, it's likely not to start at least till January 1. So you'll have some opportunity to do something about it. But to your point, and we haven't even mentioned the debt here, the U.S. debt we're talking about, not your personal debt. But as that continues to accelerate through the $30 trillion threshold, which is just wild to say, but you are going to more than likely see higher tax brackets in the future. So I also think for Anthony, this makes sense too. And we've talked about a lot of things here, but I think one thing that makes sense is to create a retirement income plan now. If you're at 62 and you're retired, you need a retirement income plan to begin withdrawing some of that money, begin to unwind those IRAs. I don't think there's ever been a more important time to have a plan to unwind your IRA. Now, people go, well, what do you mean? We're going to have to pay taxes on it. Yeah, but you can control how much you take out in a given year. When you pass it on to your heirs, the next generation does not have any control, very little, on how they're going to be able to have to withdraw that. So it makes sense to me to begin doing it now, and you don't have to spend it, because that's the next piece to it, right, John?
That's right.
People go, well, I want to preserve the wealth. Well, you can preserve it much better, honestly, once it's out of the IRA now than you ever have been able to before since 2020.
Scott, there is just a myriad, just a maze of all things that are possibilities here as far as the tax code is concerned, the economy and all of that. And that's why it is so important that you form a relationship with an advisor and work very closely with that advisor. We have ongoing discussions on a daily basis with our clients about things that are coming up and whether you should take advantage of it or not, and vis-a-vis whatever it is that your vision is and your goals are as far as your finances are concerned. We talk through those things on an ongoing basis. It is wise counsel that we are imparting to our clients as we see the landscape of things as they unfold, like what is happening in the current administration. we're going to look at this. We don't have a crystal ball. We're not going to know whether Congress is going to pass a repeal of the income tax, for instance, and a use tax or a sales tax to replace it. We're not going to know that. But when we do know that, then we are going to know what move you need to make with your finances. And I think that's where proper guidance is necessary if laws change, because once those laws change, you've got to be able to react to it.
Anthony, we're going to name your question the question of the week and send you a free Get Ready for the Future Show tumbler for being the question of the week. We just need you to email us. Send it to show@getreadyforthefuture.com to claim it. Moving on to Hannah in Fort Smith. I'm considering accepting a job offer that pays less per hour but has a pension if I stay 10 plus years. How can I value today's wages against a possible pension? Well, that's a great question, Hannah. I don't think that, first of all, I would say it's probably not a good idea to solely think about this from a financial perspective, and I'm sure that she hasn't, but you have to think about your work life, right? How is that job going to be on your personal life? How's it going to weigh on or be additive to your personal life? Are you going to be excited about that? Are you going to be motivated about that? I mean, I think you spend so much time at your job, you better be thinking about that, and I think that she probably has. But past that, you need to make sure also that you don't blow up your monthly budget by taking less income today, because we hope that you're already have already built a financial plan, a retirement plan, and you know where you are on track for that. Certainly a pension can be super additive to that when it comes to retirement income. But if you are taking less pay now, are you going to be able to continue to contribute at least at some level, if not your current level, to your retirement accounts?
Scott, what I know is pensions are great. They are regular, predictable, dependable sources of income that help you meet your required expenses in retirement. It is part of the GenWealth Ready to Retire process to evaluate a pension and make sure that we understand how that plays into that equation. However, what I also know is that someone who just has a pension and that's it is in pretty tough shape, because most pensions don't inflate. Your first check is your best check unless you work for the government, and then there's usually a cost of living adjustment built into government pensions. Now, that being said, what I believe is you've got to evaluate your ability to contribute to your 401k plan in addition to your pension, because you're going to want to have discretionary income. You're going to want to increase your income over time on top of that pension to offset the effects of inflation. We know what inflation does to you. We got a real good lesson in that in the last 2 or 3 years. So you've got to be more diverse than just going for a pension. And if you can't pay your bills today, that pension doesn't matter in the future. So you got to think about how much less income are you going to take on that situation, on that opportunity to get that pension, because a dollar today is worth a lot of money when you need that dollar, as opposed to a pension dollar sometime in the future.
Yeah, let's kind of drill down on a little bit of math here before we move away from Hannah here. But I think one way you can compare, all those things are considerations first, but if you're looking to just see an apples to apples comparison as best as you can create that, if you think about if you don't take the pension, if you don't take the job with the pension, do you know where you're going to end up from an asset level based on current contributions, based on future contributions? If you haven't done that, or if you don't know, make a plan to see where your future expected retirement date, let's say 65 years old, you need to know, if I keep doing X, I'm going to wind up with potentially, based on assumed rates of return, a certain amount of assets. And if you take 4 or 5% as a general rule of thumb on a withdrawal from that amount that you're going to end up with, that's probably, and then divide it by 12, that's roughly, as best you can get to, a good rule of thumb to say this is going to be my monthly benefit from that future lump sum, right? And then see what the pension is going to look like on the other side of that, right?
Yeah.
If you work and see how it compares. But even then, John, I think it's not apples to apples, because there's no liquidity in that pension payment. There could be liquidity in investments.
That's absolutely right. And if you need it $20,000 or $30,000, don't call the pension company because they're not going to give it to you.
No forwarding.
There is no cash balance in that pension after you start drawing it. So I think that there's use the word balance. There is balance that is necessary here. You have to think about it from the standpoint of your current income. You have to think about it from the standpoint of your future income. And I'll summarize what Scott just said. You need to plan.
Yeah.
You need to plan with an advisor who can ask the right questions of you, get the right information, and make a calculated decision based on the facts, not just on the feelings.
Yep. Hannah, thanks for the question. We want to remind all of our viewers and listeners to subscribe to our YouTube channel for exclusive content you can't find anywhere else. If you're watching us on YouTube, you already know that. But if you listen on podcasts, which we know a lot of people do, and a majority of you still listen on radio, we're thankful for that. But if you subscribe to our YouTube channel, there's all kinds of exclusive content to help you discover, protect, and share true financial independence. Just search for GenWealth Financial Advisors on YouTube. I love our mission statement, John, because somebody is in one of those three stages. They are either trying to discover it, protect it, or share it.
Yeah, that is our mission statement, true financial independence. What is true financial independence? It's where you have the ability to wake up every day and not worry about where your paycheck is coming from. That is the mission of GenWealth Financial Advisors. If that's your mission, then we probably ought to get together.
Yeah, and there's a toll-free way to do that. Call us at 866-653-PLAN. That's 866-653-7526, or you can send us an email. Send it to show@getreadyforthefuture.com, and someone will get back with you and match you with an advisor closest to your geographical location. We have offices all over the state now. We're in Conway. We do the show right here in the West Little Rock office. We're in Bryant, Hot Springs, El Dorado, and in the Shreveport-Bossier City area in northwest Louisiana. Our final question of the day comes from Kim via text. I'm 63 and just inherited about $450,000. How do I make sure this money lasts and I'm making the smartest move with it? Kim, it's a great place to start with your focus being on how to make it last. If you're 63, you're probably getting close to, if you're not already into retirement. If you're not in retirement already, you're in the retirement red zone. So it becomes very important. What are you going to do with the $450,000? How can it help you achieve true financial independence? But the first thing, we have to identify where the $450,000 is, because that matters, John, from a potential tax implication.
Yeah, it could be in an inherited IRA account that maybe a parent left you or whatever the case may be. It could be life insurance death benefits. Just those two alone have stark differences in taxation. No taxation on the life insurance death benefit. There is full taxation on the IRA. And as we said earlier, you have to take that out over a 10-year period of time. Did the money come from a bank savings account? Did it come from a brokerage investment account? If so, you probably got to step up in what's called the cost basis, and you may not pay any tax on the principal that you invested. So there is a huge question about where this money is currently located, where its original source is. Now, I think that an accurate evaluation of where you currently are on your path to financial independence is really important here. This $450,000 has theoretically landed out of the blue. What else have you done to get prepared for retirement at 63 years old, I'm sorry. So obviously you've probably made some preparations there. There's Social Security. Maybe you've got a 401k plan or whatever. How does this play into the bigger picture? It's oftentimes, not a smart thing to do what I call mental accounting. And you basically take this $450,000 and say, okay, I'm going to put this label on that. And this over here is my other stuff. That's my retirement. Maybe the two need to be merged together in terms of creating an income stream for you, because that income stream is the first step toward that financial independence.
Yeah, and that incorporates her first question on how do I make sure the money lasts, because you don't know how long you're going to live, Kim, and we want to make sure it never runs out. But building that retirement income plan starts with evaluating your expenses. How much are you going to need to live on a monthly basis just for a basic lifestyle? And then we compare the other side of the equation there to what kind of guaranteed income sources are you going to have on a monthly basis. If you're 63, you are likely eligible for a reduced Social Security benefit, but is it time? If you're still working, it's not going to be time to take it yet, more than likely. But if you get closer to retirement, whenever you do actually step away from work, if you haven't already, you can evaluate, is that Social Security check going to be enough to provide myself with a basic lifestyle? If not, we would need to look at other investments to incorporate additional guaranteed income just so you can pay the bills. Now, beyond that, what does retirement look like? What do you want to do? What's the quantifiable monthly income equivalent to what is my lifestyle going to look like? Do I want to travel a lot, or am I going to stay at home? Those are two very big differences from a monthly income perspective. But then as we determine those numbers, you'll see, am I short or am I good? And if you're good, that $450,000 can be potentially earmarked for another reason. But if you need some or all of it to create the true financial independence you're looking for, then that would be incorporated, as John has already mentioned, into the overall plan. And how we do that, John, the investment strategy is vitally important here. We talked about at the beginning, Kim is either in retirement or she's in the retirement red zone.
Yeah, you've got to be prepared for, what happens as you approach retirement. There are some really not so great things that can happen if you have the money more aggressively invested as you head toward retirement. About the time you need it, the old saying of the 401k became a 201k. You don't want that to happen. Here's something else that I think I want to be sure to emphasize in this situation, Scott, is to get a plan regardless of what your goal is, and don't let the money just sit and be slowly spent on life, because for some strange reason, there's always something to spend money on. And it seems to, I don't want to wax mystic here or anything, but it seems like the forces of nature know when you get a bunch of money, because all of a sudden, all this stuff starts happening, and you got to spend it on this and you got to spend it on that. And sooner or later, you're going to wake up and go, that's all gone. And I was not intentional about it. I did not have my focus on what I needed to have it on. I was too busy putting out fires. And you have to ask yourself, okay, if those fires had occurred before I got this money, how would I have handled them? Oftentimes, that's the real kicker on lump sum money like that. It makes it really easy to go put out a fire. I think sometimes family members go, oh, well, mom got that money. I'm going to just, I got this bill over here. I'm going to see if I can maybe talk her into sliding me a few dollars and help me out with this. And sooner or later, Scott, it slowly leaks out of your bank account to somewhere else, and your financial independence is gone with it.
You know what I also see is the opposite of that potentially. You put it over on the sidelines. You don't really want to invest it. You don't want to get it working for you because you're not sure what you're going to do with it. And if you don't make a plan, you could be looking up 2 years later. Let's say you did that a couple of years ago and the markets had a 40% run up and you were sitting on the sidelines trying to figure out what you were going to do with it.
Yeah.
When you could have incorporated it into your overall plan.
Oftentimes fear is a paralyzer, and that's what happens in those situations. You're fearful of making a decision on it, so your indecision becomes your decision.
And the plan is the antidote on both sides of that, right?
That's exactly right.
If you're worried about spending it, if you're worried about not spending it, it could happen, but getting a plan together can make all the difference. Time for our final thoughts, as I blew right through that final bell. John, we'll start with you.
Well, Scott, as I review back on the questions that we've got, there's a lot here today. There's things about estate planning. There's things about investing. There's things about what to do with the lump sum. It all comes back to having that personal relationship with a financial advisor, that they know you, they know your situation, they know how you want and need to deal with certain things that come up in life. They are your financial coach. They're coaching you along. You've got to make the decisions. The financial advisor is not going to make the decision for you. They're going to give you options. They're going to help you think through the logistics of whatever your situation might be. And then you're going to be empowered at that particular point in time to make the decisions that are in your best interest and put you on a path toward financial independence. If you'd like to do that with us, reach out to us here at GenWealth, and we'd be more than happy to work with you.
And I'll just piggyback off of that in our final 30 seconds to tell you how you can get in touch with us. I think back to our mission statement. We help people discover, protect, and share true financial independence. I don't know nobody has ever told me that they didn't want that, but putting in the work to build the plan or realizing that it can happen for you is where most people get stuck. So don't delay. Call us now, 866-653-PLAN. It's 866-653-7526 to build your plan for true financial independence. And that is all the time we have for this week's Get Ready for the Future show. We thank you for being with us. And if you have a question, it's easy to get it into us. Just text or leave a voicemail at the following number, 501-381-5228. We'll see you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.
If you look across the